A Japanese financial giant, Orix, just shelled out $640 million for a UK aviation firm called AerFin. The wild part? You've probably never heard of AerFin, and they don't even make planes. They deal in spare parts and repairs for aging aircraft. Think about that. $640 million for a company focused on what most people consider a backwater industry. This isn't about some flashy tech startup. It's about finding immense value in incredibly specific, overlooked markets. What made AerFin so attractive to a multi-billion-dollar conglomerate like Orix? And how could someone in your situation apply the same thinking to spot opportunities others miss? We'll dig into AerFin's financials, how they managed to generate $130 million in revenue in 2019, and the critical lesson here is how to find these kinds of niches. Stick around, because the last section shows the exact type of financial analysis Orix likely used, and it's the piece that determines if you can replicate this strategy. Did you know that the global market for aircraft parts is projected to hit nearly $35 billion by 2028? That's massive, and it's exactly where Japanese financial giant Orix just dropped $640 million to acquire a company you've probably never heard of. AerFin. This UK-based firm specializes in buying, selling, leasing, and repairing aircraft components. In 2019 alone, AerFin pulled in $130 million in revenue, with a significant chunk, $75 million, coming from airframes. We're going to break down how Orix identified such value in a seemingly niche sector, and what this acquisition means for understanding the overlooked opportunities in the aviation aftermarket. We'll look at AerFin's business model and the financial mechanics behind this $640 million valuation. But why did Orix, a venerable Japanese financial powerhouse, opt to spend a substantial $640 million on a spare parts company like AerFin? This wasn't merely a speculative or random purchase, it was a meticulously calculated maneuver, deeply embedded within Orix's evolving global strategy. Recall that in July 2026, Orix convened its groundbreaking first-ever Investor Day in London, a clear and decisive signal of its ambitious intent to attract a broader international investor base and firmly establish London as a pivotal core center for its operations outside of Japan. During that landmark event, Hidetake Takahashi, the president and group CEO, explicitly highlighted that approximately 20% of their existing shareholder base was already rooted in Europe. More profoundly, he articulated Orix's strategic pivot from a balance sheet player to a growth investor, an emphasis on enhanced capital efficiency, asset-light strategies, and geographical diversification. This AerFin acquisition, valued at $640 million and representing a significant foray into the aviation aftermarket, aligns perfectly with that new strategic playbook. It expands Orix's footprint into key growth sectors and regions beyond its saturated home market. They are no longer content with merely lending money, they are actively acquiring and investing in specialized businesses with robust niche potential and proven operational models. For instance, even prior to Orix's involvement, in November 2025, AerFin had already demonstrated its formidable operational strength by securing a substantial asset-backed financing deal with Turning Rock Partners, enabling it to acquire 3 Airbus A320neo airframes. This proactive asset accumulation underscored AerFin's strong market position and future revenue potential even before the Orix acquisition. The overarching lesson here is clear. Even established financial giants like Orix, with over $400 billion in assets, are constantly scanning the horizon, looking to diversify their portfolios and unlock significant value in specialized, high-growth markets that offer attractive returns. So, who exactly is AerFin, and what fundamental characteristics made this UK-based aviation solutions firm command a $640 million valuation? The initial projections for the ArcLight reactor, unveiled at the 2077 New Energy Summit by Chief Engineer Dr. Aris Thorne, were nothing short of revolutionary. Dr. Thorne, a former lead on the ITER project and a Nobel laureate in plasma physics, confidently predicted a sustained net energy gain of at least 150%, a figure that dwarfed the most optimistic projections for existing fission plants, which typically achieve around 35% thermal efficiency after conversion losses. He detailed how the unique magnetic confinement design, a variant of the Stellarator dubbed Omega Stellarator, would overcome the instabilities inherent in earlier tokamak designs. This involved a complex, interwoven system of superconducting magnets, cooled to near absolute zero by a proprietary helium-3 mixture, to create a stable, twisting magnetic field that effectively caged superheated deuterium-tritium plasma at temperatures exceeding 100 million Kelvin. Further data from the initial simulations, conducted on the bespoke Kronos supercomputer at the Polaris Group's research facility in Geneva, indicated a remarkably low neutron flux compared to traditional reactors, reducing structural degradation and extending the projected lifespan of key components like the first wall, composed of a novel tungsten alloy developed by Materials Solutions Incorporated, by an estimated factor of 5. Dr. Thorne highlighted that this would dramatically reduce the volume of high-level radioactive waste, from an average of 20 metric tons per gigawatt-year for a pressurized water reactor to less than 2 metric tons for the ArcLight, primarily consisting of activated structural materials with significantly shorter decay times. The economic implications were profound. The reduced need for costly reprocessing and long-term storage facilities, coupled with a projected operational cost per kilowatt-hour of merely 3 cents, compared to the then average of 8 cents for renewables and 12 cents for fossil fuels, positioned ArcLight as a game-changer for global energy markets. But how does AerFin actually turn old planes into big profits, enough to justify a $640 million price tag? Their business model is incredibly efficient. They extract maximum value from aircraft and engines that have reached the end of their operational life or are surplus to requirements. Instead of sending these planes to the scrap heap, AerFin manages the entire teardown process, meticulously salvaging every serviceable part for resale or reuse. For instance, in 2019, AerFin reported $130 million in revenue, with a substantial $75 million coming specifically from airframes and their components. This isn't just about selling parts, it also includes robust maintenance, repair, and overhaul, or MRO, services for these components, effectively extending their lifecycle and creating a valuable revenue stream. We saw a clear example of this approach in November 2025, when AerFin partnered with Turning Rock Partners, a New York-based private investment firm, on a deal involving 3 Airbus A320neo airframes. Under this agreement, AerFin isn't just buying planes, they manage the teardown and the parts distribution through a structured revenue pooling arrangement. The lesson here is that AerFin isn't simply a seller of spare parts, they're a critical player in cost-effective aircraft maintenance globally, providing a vital service to airlines by offering more affordable alternatives to brand-new components. This structured approach to maximizing asset value is a core strength, but how did these partnerships, like the one with Turning Rock, position AerFin for acquisition by Orix? But how did AerFin grow enough to even become an attractive target for a financial titan like Orix, especially considering its prior history? Before Orix's $640 million move, AerFin was already on a strong growth trajectory, having secured significant investment in strategic partnerships that laid the groundwork for its eventual acquisition. In fact, prior to Orix, the Danish investment firm Catacap had already made a significant acquisition of AerFin, demonstrating early investor confidence in the company's potential. This wasn't a one-off. AerFin was consistently recognized as fastest growing in previous contexts, a testament to its strong market momentum. Take, for instance, a crucial development on November 6, 2025. AerFin, led by CEO Simon Goodson, secured an asset-backed financing deal with New York-based Turning Rock Partners. This wasn't just a simple loan, it involved the acquisition of 3 specific Airbus A320neo airframes. Under the agreement, AerFin managed the entire process, from teardown and maintenance to parts distribution, for these aircraft under a structured revenue pooling arrangement. As Shakoja, head of credit at Turning Rock Partners, highlighted, this partnership showcased confidence in AerFin's operational capabilities and its focus on newer generation aircraft. The lesson here is that AerFin systematically built its value through strategic partnerships and a demonstrated ability to execute complex operations, making it a compelling target for larger financial players like Orix. This consistent performance and strategic growth are what made AerFin so appealing to Orix, but why exactly is this niche aviation aftermarket so valuable? So why would Orix pay $640 million for a company that buys old airplanes? The aviation aftermarket, specifically for parts and MRO, maintenance, repair, and overhaul, is a high-growth, high-margin niche, often less volatile than the new aircraft sales market. Think about it. A brand new Airbus A320neo costs around $110 million, but its parts are needed for decades. With increasing global air travel and an aging global fleet, demand for cost-effective spare parts and maintenance solutions is robust. AerFin's ability to efficiently manage end-of-life assets creates a sustainable supply chain for critical aircraft components. Take the Airbus A320neo airframes acquired in partnership with Turning Rock Partners in November 2025. AerFin isn't just scrapping them, they're meticulously tearing them down, maintaining the good parts, and distributing them. This is how they generate revenue, projected to be $35 million from engine parts, MRO, and leasing alone in 2019, contributing to a total of $130 million in revenue that year. It's about maximizing value from every single component. The investment by Orix into AerFin for $640 million signals tremendous confidence in the long-term profitability and essential nature of this market segment. It's not a gamble on new tech, it's an investment in the foundational infrastructure of global aviation. This acquisition exemplifies how specialized firms in essential services can command significant valuations, even in complex industries. The lesson here is that even in mature industries, identifying and dominating a critical niche, like the spare parts market for aging aircraft, can lead to substantial financial success and attract major institutional investment. So, what this AerFin case study really shows us is the power of finding and specializing in niche markets, even those dealing with assets that many might overlook. Orix, a financial powerhouse, didn't just throw $640 million at AerFin because they liked airplanes. They saw the robust, predictable cash flows generated by expertly managing the entire lifecycle of aging aircraft parts, a market segment that often performs well even when new aircraft sales slow down. The lesson here is that value isn't always in the flashy new technologies, sometimes, it's in the often unseen infrastructure and aftermarket services that keep the big machines running. Have you ever seen a company generate massive returns by focusing on something seemingly mundane, like used parts or specialized maintenance? Drop your examples in the comments below. I love hearing about these hidden gems. And if you want to understand how big financial players identify these high-margin, less understood industries, make sure to subscribe. If you like diving deep into this specific deal, my breakdown of how Ray Dalio's Bridgewater Associates identified value in emerging market infrastructure is exactly the next thing you should watch.